Have you ever wondered if an AI could learn to predict stock prices just by trial and error, like a human trader mastering the market by playing it over and over again? Imagine an algorithm that learns from its own actions, making smarter decisions each day, all in pursuit of maximizing long-term profit. This isn't science fiction, it's reinforcement learning applied to the world of stock trading. And today, we're diving deep into how it all works. Reinforcement learning is one of the most fascinating areas of artificial intelligence. Unlike supervised learning, where a model learns from a labeled dataset, reinforcement learning involves learning by interacting with an environment. The agent tries different actions and learns from the consequences. It's how AlphaGo beat the world's best human players at Go. It's how self-driving cars navigate streets. And now, it's how AI is starting to make sense of the chaotic, unpredictable world of stock markets. Let's break it down. In the world of reinforcement learning, we have an agent, an environment, states, actions, and rewards. The agent is the learner or decision maker. The environment is everything the agent interacts with. In our case, the stock market. The state is a snapshot of the environment at a given moment, like stock prices, technical indicators, or even global news headlines. The actions are the choices the agent can make: buy, sell, or hold. And the reward is the feedback signal. For stock trading, that might be profit or loss from a trade. Now picture this. The agent starts off with no knowledge at all. It makes random decisions. Sometimes it wins, sometimes it loses. But each time it acts, it gets feedback. Over time, it starts recognizing patterns. It starts understanding what kinds of decisions lead to profit. It adjusts its strategy, learning to favor actions that maximize long-term reward. That's reinforcement learning in action. The real power comes from a special algorithm called Q-learning. Q-learning is a model-free algorithm, which means it doesn't need to understand the full dynamics of the environment in advance. It simply learns the value of taking a certain action in a certain state. These values, called Q-values, represent the expected future rewards. The goal is to learn a Q function that can guide the agent to make the best possible decisions at each step. Let's make it more concrete. Imagine feeding the agent with inputs like current stock prices, trading volume, moving averages, RSI, MEC, news sentiment, and other indicators. These inputs define the state. The neural network then predicts the Q values for each possible action. The agent picks the action with the highest Q value, say, buying the stock, and observes the result. Did the stock go up? If yes, the reward is positive. If not, it might get a negative reward. Based on this, the neural network updates its weights to make better predictions next time. Another issue is exploration versus exploitation. Should the agent stick with strategies it knows work well, or should it keep trying new ones to discover potentially better paths? This balance is crucial. Too much exploitation, and the agent might miss out on higher reward opportunities. Too much exploration, and it might keep making risky, unprofitable trades. Smart algorithms manage this trade-off dynamically, adjusting their exploration rate over time. There are also more advanced techniques beyond deep Q learning. One of them is policy gradient methods, which directly learn a policy, a mapping from states to actions without estimating Q values. Another is actor-critic methods, which combine value-based and policy-based approaches, using one network to evaluate actions, the critic, and another to decide what to do, the actor. These methods tend to be more stable and effective in continuous or highly stochastic environments, like financial markets. A popular variation is the proximal policy optimization algorithm, or PPO. It's one of the most powerful reinforcement learning algorithms and is often used in environments with continuous action spaces. First, you need data. Lots of it. Historical price data, technical indicators, volume, volatility metrics, earnings reports, macroeconomic indicators, news feeds, social media sentiment, anything that might influence stock movements. The richer the data, the better the model can learn. Then, you define the environment. This includes what the state looks like, what actions the agent can take, and how rewards are calculated. For example, you might design the state as a combination of price trends and indicators over the last 10 days. The reward could be the profit or loss from the action taken. Next comes the neural network architecture. A typical setup might include fully connected layers, LSTM layers to handle sequences, or even convolutional layers if you're treating the data like an image. Some researchers are even experimenting with transformers to capture long-range dependencies in market behavior. After training, you evaluate the model on unseen data. This is crucial to check if it's overfitting. If it performs well on the test data, you might consider deploying it in a live environment, but only after rigorous backtesting and risk analysis. Risk management is critical. Even the best model can make mistakes. Stop-loss mechanisms, position sizing rules, and maximum drawdown limits are essential to prevent catastrophic losses.